Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey, everybody. Welcome back to the DIY Wealth Canada podcast. I'm Bob. Alongside with me is my co-host, Nelson. Today, we're going to talk about monthly dividend stocks. There's just lots to go over when it comes to monthly dividend stocks. Why are people thinking buying monthly dividend stocks, the pros and cons? And we'll talk about many different names and why we like them, why we dislike them. So yeah, it should be an interesting one. Nelson, so monthly dividend stocks, let's just get into it. Why would people want to purchase monthly dividend stocks over quarterly dividend stocks?
Bob, my first reaction whenever it comes to monthly dividend stocks is kind of a little bit of skeptical of, why does this really matter? Why does it matter that people get paid monthly? And I think a lot of it is psychological, because I think it's perceived that if you get a smaller dividend, smaller distribution every single month, you get the notification on your phone, or at least I do when I get dividends, and you just get this little dopamine hit every time that income comes in. Every time that notification pops up, there's that little feeling of, woo, free money. And yes, I know dividends are not free money. They're paid out of the company's earnings, blah, blah, blah. I understand that. But it still feels good to get money every month. And it feels good to get that regular dopamine hit of, hey, I'm getting some more money. So that's part of it. I think the other part of it is that our bills generally seem to come in on a monthly basis. I know my power company wants to be paid every month, and so on and so on. And I think that meshes really well with the amount that we get every month, and then you get these bills coming in every month. They sort of match up, and you can kind of, you get a monthly dividend of, say, $50 a month. Your cell phone costs you $50 a month. So then mentally you can say, hey, this whatever dividend, this monthly dividend covers my cell phone bill. So I think those two reasons are a big reason why people like monthly dividends. Bob, can you think of anything else that I might have missed?
Oh, I think that's it for sure. The idea of having equal monthly dividend income, something that's not lumpy, right? So when you get quarterly dividend income, quite often than not, and our dividend income is certain like that now, whereas it's quite lumpy, right? So there will be few, like some months were very, very strong, some months were really, really weak, relatively speaking. Whereas if you're primarily on monthly dividend income, your distribution or dividends are paid out monthly, then it's not as lumpy. So if you look at our dividend income history, when we started, kind of by luck and coincidence, our dividend income was relatively steady. And that was because we had a lot of stocks that were paying monthly dividend income, mostly in REITs and income trusts. And over time, we have shifted a little bit. So now our stuff is a little bit more lumpy. So that's one. And then two is maybe a little bit when you're in the accumulating phase, if you're dripping, meaning you're reinvesting your dividends every single month and you're getting paid every single month, you could potentially compound faster than on a quarterly basis. So maybe that's another factor that people kind of lean toward monthly dividend stocks. But I think there are obviously pros and cons for it. But if you're really focusing on like having that steady dividend income, I think it kind of narrows a little bit your choices, and you may end up picking, you have less stocks to pick from rather than a basket of stocks to select from.
Yeah, I think too that we talked a few weeks ago about the difference between income investing and dividend investing, and we talked about these income products that are paying return on capital and are doing these sort of funky things that aren't really dividends, but kind of get grouped in the same basket. And I think that, those products have become quite popular. We talked about that. Yet a lot of them pay monthly. And I think that that's the popularity of these products combined with the pros that kind of we both talked about there of, getting that money quicker and the how it meshes with monthly bills and so on. I think that factors into that as well, where it's like, hey, the popular product pays monthly, therefore people are excited to get monthly and they want more, whether it's a stock, whether it's an income fund or an ETF or whatever. But the point is they want more things that pay monthly because the regular investor likes that monthly payout. But I want to come back to, Bob, you mentioned that you had more stocks that paid monthly, and then you've kind of moved away from that. You moved to more quarterly. Was that, maybe talk us through that decision? Was that something you did because those stocks weren't really giving you a lot of growth, or what was the thought process there?
Yeah, that's exactly it, right? So if you look at monthly paying dividend stocks, primarily would be the REITs. Those are the real estate income trusts or your regular income trust. So those typically pay out monthly, or I guess if you include these high yield ETFs as well, those pay monthly dividend or distribution. But when it comes to REITs and income trusts in general, even though their initial yield is very, very high, typically north of 4%, or even some are like, 5, 6, 7%. The dividend growth aspect of them are not very good. So typically they don't grow their dividend payout regularly. So even though your yield, the initial yield is high, you don't really grow your dividend income over time unless you're buying more shares of these monthly dividend paying stocks, either via new capital or you're dripping. So yeah, over time, we kind of realized that dividend payout increase is important. That's when we start shifting more and more toward quarterly paying dividend stocks rather than monthly dividend stocks. So that was probably the prime reason for us to do that switch. And also, we just found we had too much REITs in our portfolio, so we slowly shifted away from REITs. That was another reason. Nelson, do you own quite a bit of monthly dividend stocks, or you just kind of been monitoring them?
Yeah, so I monitor the entire universe of Canadian monthly dividend stocks. I do it partly as a service for my newsletter readers, because what I found is that people are very interested in this sort of subsection of the dividend market. In terms of what I own, Bob, I was kind of like you, where at one point I have too many REITs. It was kind of this sort of 2022, 2023 period. I realized that I had too many REITs, but mostly I had too many of the wrong REITs. And so I remember when we talked about REITs, and I think it was episode 2, just weeks ago now, I talked about how I want a REIT that's going to grow over time. And what I had in my portfolio was I had too many REITs that just didn't offer any growth. The payout ratio was too high. The income was good, but the payout ratio was too high. So they didn't really have enough excess income to reinvest in new properties or development or whatever. So I have been slowly selling off some of these REITs over time and concentrating more on REITs that I think can grow. And so this is a kind of a long-term portfolio goal of mine. I still have a few too many REITs that don't offer that income growth, that distribution growth, but I'm working in that direction. REITs, of course, were very weak in the kind of 2023, 2024 period. And even now they've recovered some, but they're still not nearly as high as they were in that 2021, 2022 period. So basically, I'm slowly doing the same thing that you did, Bob. I'm getting rid of some of these names to maybe just add a little bit more growth into the portfolio. And that's a really big con for, we talked kind of the pros of this monthly dividend investing. That's one of the big cons, isn't it? Where you take a look at the list and there are a lot of names on there that are just mature. And they don't really offer a whole lot of growth. You really have to scour the list to find anything that really has a lot of growth potential, or really any growth potential at all. It's all very old, stodgy names, which could make sense for some of you if that's what you are into. But for people looking for growth, you have to really scour the list in order to find those growth stocks, don't you?
Yeah, and I think again, it kind of depends where you're at in terms of your financial independence journey or investment journey. If you're, a little bit older and you're relying on that income part where you need your portfolio to generate a steady dividend income or distribution, and you're living off your cash flow from your dividend portfolio, then yeah, maybe you lean a little bit harder on the monthly dividend stocks where you're really trying to get as much cash flow out of your portfolio as you can. Now, if you're a little bit younger, maybe you don't lean as hard. You sort of focus more on the dividend payout side of things. Now, another thing that just popped into my mind is that because a lot of these monthly dividend stocks are in REITs or income trust, they don't get preferential dividend treatment. What do I mean by that? Is that these companies, when they pay distributions, these distributions are not taxed on a corporate level. So a lot of these companies just pass their part of their profit down to the shareholders. So you end up needing to pay a little bit higher taxes when you receive these distributions. Now, if you hold these monthly dividend stocks in your TFSA or RSP, that's fine. You don't have to pay taxes. But if you hold them in your non-registered account, it gets kind of tricky. So that's another con for kind of work against these monthly dividend stocks. Can you think of another con for holding monthly dividend stocks, Nelson?
Well, I think it's a good time to transition into what's these large kind of categories of monthly dividend stocks. And Bob, you talked about a couple of them where you have a lot of REITs. In fact, I think just about every REIT in Canada pays monthly. And then you have these old income trusts. Of course, I'm old enough to remember the income trust boom in the kind of 2002 to 2006, 2007 period, where it seemed like every IPO on the TSX was an income trust and it paid anywhere from 8 to 14%. All these dividends or distributions back then that just weren't really sustainable. So you had both of those. And then the third category, which you see today, there's an awful lot of oil companies that debuted as income trusts and have sort of maintained that income trust philosophy of paying monthly dividends. But I think that the oil companies in general, those dividends are just about always on shaky ground because the price of crude fluctuates so much. And when you have that fluctuation, you don't know what the price of crude is going to be next week. It could be $65, it could be $100, it could be $30. And it doesn't go that much on a week-to-week basis. But the point is that it has gone up that much and it has gone down that much in the past. And we can all remember that. So that's the problem with some of these, like you have the REITs that are very steady, very generate a lot of steady cash flow. And then you have oil companies that would probably do the same if oil would stay at one same price. But oil, of course, doesn't do that. And you get to the point where when oil falls, that a lot of these guys will cut their dividends. And that's obviously bad news. And it's obviously a danger for people who are looking at those types of stocks. So I would be very cautious in terms of oil stocks, and I'd be very cautious in general, just looking at these types of companies, especially the ones that pay the anywhere from 6, 7, 8, 10, 12% yields. They all exist, and that part is a little scary if you keep moving up and kind of insisting on more yield.
Absolutely. So, I mean, higher the yield, the generally speaking, higher the risk. The other one you really need to think about is if you only pick monthly dividend stocks, you're your selection, and I mentioned this earlier, your selection or number of stocks available for you to pick becomes really, really small compared to if you don't have that restriction. And I find if you restrict the number of stocks that you can select from, you kind of limit your return, you're increasing risk because you're kind of, instead of selecting for from 100, 200 individual dividend stocks, now you're only selecting maybe 10 or 15, right? So maybe these 10 and 15 are not as stable and they're on shaky grounds compared to the 200, 300 you could select from. So that's another thing to consider. And again, that's why we started shifting away from monthly dividend stocks over the years. I'm not saying it's not the right strategy to use. It just depends on what you're trying to achieve with your investment portfolio.
Yeah, I think the other thing too that you sort of were going in that direction is that I think a lot of the good monthly dividend payers end up going away. And I'm thinking of the fast food royalty space more in general, but I'm thinking of, more recently we had the Keg was acquired by Fairfax Financial, which bought the Keg restaurant off of, that was part of Cara Foods Recipe Corporation. And then they bought the royalty trust. So that is the company that owned the Keg copyright, the royalty. And then they got a cut of the sales every time that, the Keg sold a steak or they sold a potato or whatever. This royalty fund would get a cut of the sales, and then that income went to investors as a dividend. And A&W recently restructured, so the operating company bought the royalty company. So those were two very popular monthly dividend stocks, and they both kind of gone away because the operating company has said, hey, wait a minute, we don't think it's a good idea to pay this royalty any longer. We're going to buy back the royalty and then tuck it in, and then we keep all the profits. So that just demonstrates the problem with the best ones seem to always get acquired. And that is like when you're looking at these types of companies, you don't want the best ones to get acquired all the time. The same thing happened with First National, Bob. Like First National is in the process of getting acquired, and that was another very popular monthly dividend payer. Can you think of anything else that's been acquired over the years, or maybe just talk a little bit more about that problem and how it is a big problem for people
acquired,
but space?
I can't think of any other ones that got acquired over the years where they just disappeared. But one that popped into my mind is Pembina. I think they used to pay monthly, and I can't remember when I think eventually they switched over to quarterly. So you have had a few monthly dividend paying stocks that went from monthly to quarterly, and that sometimes it's just for efficiency's sake for the company, and there's various reasons, right? So I have not seen a company going from quarterly to monthly. I've seen a few going the other way. So yeah, getting acquired is one, and then two is sometimes these companies get bigger where they just decide to change from monthly to quarterly payouts. So it just makes the number of monthly dividend paying stocks less and less to choose from, kind of thing.
Yeah, that's it. The best ones eventually, like you said, they either get acquired, they go away in another way. And I'll talk about the Rogers Sugar, which is one of my favorite kind of boring sort of bond proxy stocks on the TSX. It was an income trust up until the 2010 deadline, where they had to either remain an income trust but pay the taxes or flip over to a corporation. And when Rogers did that, they cut the dividend when they swapped over to become a corporation. Now it makes sense that they did that because they suddenly had to pay corporate taxes, where before they were just pushing that through and the unit holders were paying the taxes. But there's still that changeover that happened. And when it happened and in the process that it happened, it went from paying I think it was like 4 cents per month to 9 cents per quarter, which was a dividend cut. So you kind of got that double whammy there where the income went from monthly to quarterly and then it went down. Now, Pembina didn't do that. And a lot of companies that do switch from monthly to quarterly won't do that. They'll maintain the dividend, but it just makes so much more sense to do it quarterly because you have 4 distributions every year. And it costs the company money to do that, to send out a dividend. Like they have to send money out to every brokerage, and then the brokerage distributes that to you. And doing that 12 times a year versus 4 times a year, it's a relatively big cost. I wouldn't know what to put a dollar value on it or anything, but I think it would need people in the head office to coordinate that. There's bank fees, there's all sorts of fees that they would have to pay. So it makes a lot of sense for a company to just pay quarterly and save your money. Like, shareholders, we own the company. So I think that's a important thing to consider as well. Let's pivot to some of our favorite monthly dividend payers, because I feel like we're kind of bashing it a little bit here. We're focusing on the cons, but we do want to say that there are certain monthly dividend stocks that we like. So Bob, why don't you start with one of your favorites?
Yeah, I think one of my favorites, we own it and we talked about it when we had the REIT episode, that with Granite REIT. The reason is that it obviously pays monthly dividend or distribution. It has a pretty decent yield. I think it's north of 4%. And I just generally like Granite's space, right? So it invests in industrial warehouses and so on. I think that sector is growing. And Granite REIT is one of the rare ones they actually been raising their dividend payout over the years. I think they have a 14-year dividend growth streak. So, and if you look at many of the REITs, they typically don't raise dividends over the years. So, that's definitely a plus if you're looking to increase your dividend, right? So that would be one of my pick in terms of monthly dividend stocks. Nelson, what about you?
I'm going to talk about a relatively small casino operator in Alberta. It's called GameHost. And for those of you who have followed my newsletter or even on Twitter, I talk about this one periodically on Twitter. But this is just a tiny little company that I like for a couple reasons. And I'll talk first about the kind of the moat in casino operations. So in Alberta, just like a lot of provinces, there's limits to how many casinos you can open. And basically the government says that if there's a certain population in a certain area, we can assign this many casinos for this number of people. And what this does is it creates a natural moat for the casino operator. And GameHost has casinos in Fort McMurray, Grand Prairie, and then Calgary. So they have 3 casinos, and then they own a little bit of commercial property in Grand Prairie. They have a hotel right next to their casino there, and there's a little bit more besides that. But I like the moat on those casinos. I like that GameHost is about 35% insider owned. There's the Will brothers, who are I think the president and COO, I believe. Sorry if I got that wrong for their titles. And the stock is cheap. It trades at about 10 or 11 times free cash flow. And these guys have realized that there's not really a lot of expansion opportunities. There's not a lot of casinos that come up for sale in Alberta. So what they do is they pay out a lot of their income in dividends. I think the yield on the stock is kind of that 5% range. And then with the other part of their earnings, they buy back stock. And they've been pretty aggressive in buying back kind of 3, 4, 5% of the company for a few years now, each year. So you get the earnings growth that way because there's fewer shares outstanding and earnings are about the same or they creep up a little higher over time. You get the growth there as well. So you put all that together, and I think GameHost is the kind of company that like I said, trades at about 10 times free cash flow and can grow free cash flow 5 to 7% per year as they sort of milk more money from their existing operations, and they do that share buyback. So it's just the kind of boring stock that I like, that it's a business I can understand, and it just should slowly grow over time, and that dividend should slowly get higher as they increase earnings. So it's almost like a REIT where you have this, because they do own the real estate. So it's just this steady little company that you can tuck away, that should grow a little bit and should give you a decent dividend. And plus it pays monthly. So that's what I like about that one.
Nice. Yeah, that's probably a name I'm not familiar with. Coming back to me, I think I'll stay away from REITs and income trust. One name that intrigues me a little bit, and we don't own it, but we did look at it years ago, is I think it's called Severia. So they originally started off as wheelchair lifts, making wheelchair lifts, and the company has expanded into home elevators, commercial lifts, stair lifts, and ceiling lifts, and other stuff. That one's interesting. This company is interesting in the sense that it's kind of providing accessibility to folks that need it, and also for older folks. And that's a very niche area where not many other companies are in this space. So I like that. And then they haven't been growing dividend payout as consistently as I would like, but they definitely have been raising here and there. So it's not just like, flat dividend payout. They kind of raise dividend payout erratically, I would say. But the company has been growing steadily over the years, and they're expanding outside of Canada as well. So it's a company I like in general. And if you're looking for dividend payout that's monthly, that's a company worth taking a look, and then sort of do your homework and see if it makes sense or not.
Yeah, I like the long-term health play. Talk about Severia and the, like you said, the lifts and the elevators and everything. And I think about my parents. My parents are baby boomers. They're not quite at the point yet where they're going to need that sort of assistance in their homes, but they will eventually. And there's kind of two choices at that point. You either get some mobility help, get them installed, or you move to a place where that kind of stuff is included, which is seniors housing. And there's going to be a certain amount of people that are just going to say, hey, I've worked hard my whole life. I've achieved a pretty good nest egg. I can afford to spend the money to get one of these lifts installed in my house so I can continue to live at home for a few more years until I have to get put into a retirement residence somewhere. I think that that's a nice tailwind for companies like that, or even companies like, Extendicare pays monthly and Chartwell pays monthly. And those are two companies too that should get that long-term growth from our aging population, that's just a huge theme going forward, isn't it, Bob?
Yeah, for sure. And that's something, again, I think we talked about a little bit, is kind of look when you invest, look at the big picture, what's the macro trend. So that's where I look at it, and that's why I like Severia if I look at the long-term big picture. Nelson, another pick from you?
I'm going to talk about Exchange Income Corporation, which has done terrifically well in the last, I'm going to say even like 4 or 5 months. It really dipped down in the kind of April period when everything kind of manufacturing related really dipped. And then the stock has just exploded since then. So Exchange Income Fund is kind of this company with two sort of divisions, we'll call it. One is manufacturing. So they manufacture things like they make mats for oil companies. So what it is you go into an oil lease and the road is very, very muddy. So what you can do is you can rent mats that let the truck go into the lease and then do the work that it has to do, and then it can drive out and the truck doesn't get stuck in the mud. So it manufactures things like that, very boring types of things, but they're needed. The other part of the company, which is the exciting part of the company, the part I really want to focus on, is the aviation services. So what this part of the company does is it enters into contracts with various third parties to provide aviation services. So one of the things that it does is the Air Canada Rouge, or whatever it's called now, the regional airline in Canada that goes, routes like Kamloops to Red Deer or whatever. I don't know if that's an actual route, but it does these regional routes. And rather than Air Canada doing it, they contract it out to this third party. And that used to be Chorus Aviation, and now it's Exchange Income. And they do things like that. They do like charter flights up north. So normally I'm not a big fan of the airline business, but when you have something like that where it's, hey, this is a charter, it's something that delivers steady cash flow, it's needed. People go up north on a fairly regular basis, and they do so because they need to be up there, whether they're working up there or they have business up there or whatever. So those types of operations generate a lot more cash flow, a lot more stable cash flow than a normal airline, which is subject to the whims of everyone traveling. And then the other thing on Exchange is they have a air ambulance division that is entering in contracts with provinces and countries around the world. And this part of the company, if you need an ambulance in a area that cannot be reached by a regular ambulance, they send a helicopter in and they take you to the hospital that way. Or they might transport you from a small hospital to a bigger hospital in a hurry. So they call the helicopter. And this is something that is more specialized. You don't see it a lot, but it's a nice little business for the helicopter operator, which of course in this case is Exchange. And it's something that a province, it doesn't cost the province that much, but it's something that you need to have. You don't want anybody who's been in a car accident to have harm done to them because they can't get to a hospital quick enough. So it's an important thing that provinces, countries need to have, but isn't that much in terms of the budget. So it's this nice little niche area that they need to be in. And of course, the best part about Exchange is I think it's been public since, I'm going to say 2005. And I think they've had 17 dividend increases in 20 years that they've been public. So just an excellent dividend grower that might not get the respect it deserves because it doesn't quite have that annual dividend growth. I think that people really value annual dividend growth, which creates an opportunity if there's a company that does have consistent growth, but can't show annual dividend growth. Bob, do you have any thoughts on Exchange Income? I don't know if this is one that you own or that you've researched or anything, but anything you want to add on it?
Yeah, we used to own it a long time ago when we first started. I'll be honest, I didn't really know much about it and just kind of bought it because the high yield. I certainly know Exchange Income Fund is a very popular monthly dividend stock that a lot of Canadians own. So yeah, I mean, for a reason, right? So like what Nelson you just mentioned earlier. So yeah, I mean, it's a boring, I would say boring stock in some sense. It may not be the sexiest one, but it gets the job done for sure. So if you want to, something that pays monthly dividend, that is a name that's worth looking into. I think we're up against the time a little bit, so let's wrap up this episode. I think this has been an interesting discussion. I hope that Nelson and I provided some insight in terms of monthly dividend stocks and the reasons why you might want to invest in some of these monthly dividend stocks and maybe some of the reasons why you may not want to. Ultimately, you need to do the research and make that decision yourselves. And, I hope with the names that we mentioned, that kind of opens up your eyes a little bit in terms of what's possible out there. Nelson, do you have any last words to add?
Yeah, I think you really nailed it when you talked about doing research and making your own decisions, because ultimately, we each pitched kind of two different stocks, and you notice how the fact that they paid monthly dividends were pretty much the last part of the pitch. We talked about how we liked the long-term growth, we liked the sustainability of the dividend with the like something like Granite REIT. The fact that it pays a monthly dividend was not that important to us. I think that, like I said earlier, I like monthly dividends, but not to the point where I'm going to buy something just because it pays monthly. So just keep that in mind, that even though it feels good to get something monthly, ultimately it's the fundamentals of the company that's the most important. If those boxes get checked off, then by all means take a look at something that pays monthly, but don't just buy something because, monthly income. Buy it because it's a good investment.
Yeah, for sure. I can agree with you more than that. Yeah, it all comes down to fundamental. And again, that's why I said don't pick a stock because it pays monthly dividends, and that's something you really need to watch out. And I certainly have fallen into this trap. For example, when we may want to invest in a stock, we're like, oh, well, our March dividend income is low. Maybe we pick a stock that pays dividend in March, and that really narrows your selection. So the more you get away from that kind of narrow-minded thinking, the better.
Exactly. I agree 100%. All right. Well, thanks everyone for joining us. As always, Bob can be found at talkan.com, and I am at CanadianDividendInvesting.com. Please, if you enjoy the podcast, visit our websites, find us on Twitter. Bob's at Talkan, and I'm at CDI Newsletter. Thanks for listening, and we'll see you all next week.
See you guys.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at talkan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Talkan or CDI Newsletter. Thanks. See you next time.